Welcome, everyone. We're just starting the broadcast, so we'll allow attendees to start to filter in, and we'll get started in a little while. Thanks for joining us. Hey, everyone. Welcome again. It's 12:02, so we'll wait just another moment, let people filter in, and get settled before we get started shortly. Okay, everyone, welcome. Thank you all for joining us this afternoon. We're really excited to be bringing out a panel of great speakers from your peer group to talk about some very urgent and real things going on in our communities. My name is Jason Powers. I'm the Middle Neighborhoods Initiative Director at the City of Cleveland. We've begun our work here throughout the city on focusing on middle neighborhoods as a really important component of our equitable neighborhood strategy. And we're really excited to have some local experts and some people from best practices across our country here today. To start, we'll go ahead and introduce the Middle Neighborhoods work we're doing nationally. Components twofold, one being the national initiative, which through research, policy analysis, and advocacy efforts at the national level is working to move forward all of our work in middle neighborhoods throughout the country. It's coordinated by the National Community Stabilization Trust and is advised by a steering committee of some of the leading researchers and policymakers that do this work on a daily basis throughout the United States. The other prong of our work is the communities of practice. The Middle Neighborhoods Communities of Practice is a network of over 200 practitioners. These are researchers, these are local policy officials, these are community development organizations and nonprofits that share their best learnings through things like this kind of a webinar, as well as through larger group meetings and phone calls and a variety of ways that we all gather and make sure that each of us is doing what we can possibly do to move forward these communities. It's supported by NeighborWorks America and staffed by a small team of organizers. If you're interested in more information around the community practice or really all things Middle Neighborhoods, go to our website, middleneighborhoods.org. Today, we are very excited to bring you a program developed to share current and relevant information between our peers. We came up with this over a month ago, and while obviously a lot of things continue to change in our communities, we understood that it would be very important to bring out your own peers to talk about the issues they're seeing so that during a Q&A you can share exactly what you're seeing on the ground. During the COVID-19 health crisis, there are seemingly as many webinars as there are hours in the day. So we wanted to ensure the program we put together would be useful and support our network. Today, we brought together 3 experts in their respective fields who will share their experiences in middle neighborhoods. Our panel will discuss the current state of the housing market and demand for home ownership in cities, which is a fundamental component to our stable communities. Next, we'll hear from a local community development organization on their work to support small businesses in this extremely challenging environment. And finally, we're going to hear from a regional housing developer and service provider on what they're learning about their renters and their ability to cover housing costs, as well as what landlords are facing and the challenge that cities are facing as we deal with the onslaught of upcoming eviction problems in our cities. So we'll get right to our panel. I encourage, if you hear something interesting and have a question, to go ahead and use the Q&A button to insert a question. I'll be interrupting our panel, not as easily as it would be on stage, but certainly through this, we'll be able to ask all the relevant questions as we go. Otherwise, we'll hang on to them in the Q&A box and we'll get to them at the end. So feel free as you're listening to chime in. First, we have Mark Sisman. Mark is the president of Healthy Neighborhoods, Inc., a Baltimore community development intermediary organized by financial and philanthropic institutions to improve neighborhoods by increasing home values and investments. Healthy Neighborhoods is active in 46 neighborhoods and has invested over $160 million in Baltimore's middle neighborhoods. Before his time at HNI, Mr. Sisman was president and CEO of the Hippodrome Foundation, president of the Enterprise Social Investment Corporation, ESIC, of Enterprise Community Partners. He was the deputy housing commissioner for the city of Baltimore and has served as an advisor on many nonprofit boards. So I'd like to welcome Mark and hold on. Hey, Mark.
Thank you. It's nice to listen to people from Cleveland. I spent a couple of very long years there. A long time ago. Healthy Neighborhoods in Baltimore is about 14 years old. We were started by a few neighborhood leaders, banks, the Community Foundation, to solve an interesting and different housing problem. Our middle neighborhoods, which we are middle income and working class neighborhoods, were really fraying around the edges. People weren't fixing up properties. They were deteriorating. New people weren't moving in. And the incomes in those neighborhoods were high enough so they were not being served particularly well by the traditional housing programs that are income restricted. We're now a decade plus later, we've really made a very big impact in our city. We're in 46 neighborhoods. That's almost a quarter of the city. And we're making an impact that's measurable and it's different. Probably, I know you're going to want to talk about our loan pool, which has now raised $106 million. But I think it's important for you to know that the loan pool to support home buyers and home renovators was really part of an overall community development strategy. And that's what attracted banks to supporting it. And over the years, we learned these guiding principles. On day one, none of us knew any of this. Probably 5 years in, there were probably 3 or 4 guiding principles. But I wanted to walk through them with you because I think they're really important to describe the work we do and the loan pools and raising capital. We spend a lot of time teaching and training our neighborhood partners to talk about strengths and assets of neighborhoods. Our view is we're competing for people that want to buy houses in the region. And if you're in a neighborhood without strengths and assets, why would anybody want to buy there? We strongly advocate for properties getting more valuable. Appreciation is fundamental. When I bought my house, I wanted to make sure that I built wealth. And I think that's true of a homeowner who's making a choice about where to, where to buy, which neighborhood. We're not Alinsky organizers, nor are most of our neighborhoods. We organize people around positive action that's visible in the neighborhood with a lot of marketing thrown in. Our philosophy about renovating houses is we want people to over improve. We want to spend more money than the value of the house because that's how value is built and that's how appraisals go up in neighborhoods. Why do banks want to do this with us? The bankers, maybe more than you or I, believe that a strong community infrastructure really mitigates risk. Mitigates risk for a couple of reasons. Well, one is that positive action pushes up home values. But the second is if Mr. and Mrs. Smith are having difficulty making a payment on their mortgage, we ask our neighborhood partners to go knock on a door, not to collect money, but to see what's going on and to help people work with us to recast their mortgage. And we've been able to create some pretty progressive ways to keep people in houses. We measure results. We'll show you that before we're done. We've been able to convene an active leadership, but we have a lot of very senior bankers and foundation leaders, and we have one rule: they can't send anybody else. We want senior leaders because they can deliver their institutions. CRA matters. You all know that. Let's go to the next slide, if we can. We've spent now nearly $2 million on neighborhood improvements, marketing grants, paper marketing, and websites. We learned an interesting thing with the Board of Realtors. We surveyed 500 people that have bought houses in the region, and they collected all of their information at the beginning from the internet. So that if you were a neighborhood organization and you weren't marketing on the internet, you were getting left behind. And so we have helped people build websites, keep them up to date. A lot of the community work that we fund is still built on relationships and paper. And so we help people print a lot of things, a lot of brochures. Realtors sell houses a bit more than neighborhood groups. And so a lot of what we ask our neighborhoods to do is to educate realtors. An awful lot of the realtors in Baltimore don't live here. And we need to teach them more about the city and what's going on that's positive.
Mark, we've got a quick question
Sure.
to pop in here. With regard to marketing activities, now that we're about 3 months into how COVID is affecting our communities, but homeownership is still happening, sales are still up. Has it affected how people want to market living in the city or living in these communities, or has there been any conversations around that?
No, not about that. We're really a little bit surprised that we're seeing as many home buyers as we thought. Best we can tell, people think it's a great time to buy because rates are low. Our rates are a little lower, but also that they think that the market will deflate and they will get the better prices on homes. I wouldn't have thought all those things, but that's what we're seeing. The marketing is the same, but people aren't out doing things. And so there are Zoom meetings. We've had to cancel a lot of neighborhood-based events that we would normally fund. But there are people.
I apologize. Another question that came in was
Sure.
specifically, we all know obviously in our communities, there's another major conversation going on around racial justice. And we've seen protests and advocacy going on all around our country. This has affected in some ways the way that communities engage with each other. Have you noticed in these markets any conversations around that? Has it been harder to engage with your residents because of that?
No. You're really asking about racial equity and gentrification and displacement. And early on, actually the bankers on our board said, we don't want to be displacers and gentrifiers. And we did a couple of things that worked for us. One is we knew that in Baltimore, most of the neighborhood development had been with public money and had long-term use restrictions. And so we actually hired a law firm to look at the use restrictions on most of the multifamily housing that was in the neighborhoods. And what we discovered is very long-term use restrictions. so that even if we were purposefully a gentrifier, we couldn't do it in a tax credit project with a 30-year tail or with things that were funded with block grant or similar money. So we were able to say to the neighborhoods we were in, we can assure you we're affecting single family housing, but not multifamily. The second is Maryland has a very innovative law about tax increases. Appraisals can go up and values can go up, but taxes can't go up more than 4% a year. And that's offered a lot of protection in our neighborhoods.
Wow.
And it's answered the question about gentrification and displacement. That doesn't mean people don't raise it, but we've got some pretty fact-based information about it. Also, some of the neighborhoods we're in, you can still buy a house for $90,000 today. What joins our neighborhoods is the fact that real estate wasn't appreciating. And whether you're a $300,000 house neighborhood or a $90,000 house, if there isn't depreciation, new people are not moving in. So in our loan pool, we make three kinds of loans, all about making visible neighborhood change and over appreciating. Purchase, rehab, refinance, rehab, home improvement. And the loan pool is structured as a participation. In each of the three pools, we have a group of banks that assign what is a standard commercial participation agreement. So in our third loan pool, each of the banks has agreed to buy a predetermined share of every mortgage, and they don't get to underwrite it. We hired a bank, M&T Bank, and they originate, underwrite, and service on behalf of the other banks. The other banks don't love that on some days, but all the decisions are made by M&T with a lot of feedback to the local. So every mortgage is shared in the same increments with the same underwriting standards.
Mark, we've seen across the country housing sales continue to be strong. Specifically with regard to your loan pools, what kind of is activity up? Is it roughly the same? Are people asking different kinds of questions about the loans?
Our activity is up right now. Again, I'm not sure we understand why, but activity is stronger than we would have thought. Across the city, it is not, but we're seeing people that maybe when we jump into the terms of the loan pool, you'll see that we're offering some things that keep people interested in what we do. We've really operated at scale. We've raised $106 million, including 35 at the end of last year. We made a lot of loans. The city got embarrassed because we had moved ahead at such a scale without them. And so several years ago, they agreed to match fund up to $10,000 of renovation with city matching grants. It's the only piece of our program that's got an income restriction. You can't earn more than 120% of the regional median, which for a single person is about $85,000. We lend more than the value of the house, but we have no mortgage insurance. We convinced 3 foundations in the state of Maryland to guarantee the top 10% of losses on every loan, and we're lending 110% of the regional median income. We go down to 620 credit score, and we have an architectural firm on retainer that will do 3 things for applicants for mortgages. One, they'll give you good advice about how to do the renovations you want to do, whether it's opening up a kitchen or buying appliances or doing a rehab. On behalf of the banks, the firm will read every construction contract to make sure it's fair and it's detailed. And then finally, if there's a dispute on site, they'll help us resolve it. There have been very few of those. Our experience is that renovating houses is the most daunting task for the people we serve, no matter, at every income level. We meant not to have upper income limits because we wanted to encourage people of every income to choose our neighborhoods.
You know, Mark, communication is a very big hurdle right now as we try to connect with all of our residents. And obviously, your organization is well known; it's been around for a while. But how are you able to still connect to potential home buyers? How do they know about these tools, and how are you able to answer
So,
questions?
like we advised our neighborhood partners, one is we've got a pretty decent website that's up to date that tells you about these things. The second is we help fund 10 or 11 nonprofit organizations that serve these neighborhoods. And uh, their job is to make sure the neighborhood is well informed, that they run small marketing events, that they're in touch with realtors, and that they are in a constant positive sell mode. And we can see the difference. And we, we get referrals from neighborhoods and from realtors. And I meet with my colleagues once a quarter after our board meetings. We meet with the executive directors of our neighborhood partners. We really want them to be well informed and comfortable with what we're doing. We're not in the neighborhood unless we're invited to be there. And
And
obviously we talk a lot to the city and the state.
can you speak at all to the last few months? Obviously, some of those meetings have either been pushed off or they've been done through Zoom instead of perhaps in
I,
person.
one, we do them through Zoom, harder for me than most of them. I think the second thing is that I spend a lot of my time talking to partners. Some of those partners are banks, and other of those partners are neighborhood leaders. And we try and be very visible out in neighborhoods, even in the time of COVID virus. I think the hard thing for our neighborhood partners is, I think community development and organizing is a very face-to-face business. And it's awfully tough for us to be demanding of neighborhood organizations to organize face-to-face events in this environment. And most of our neighborhood groups are highly ideological. And when they were faced with COVID virus and service needs, that's what they did. And they put aside our work and did what they needed to do in neighborhoods. And that's what they should have done. This is what our mortgages look like. We made up the 4% number 10 years ago. It's probably going to have to drop some. We're at about, we're a little bit higher than the market rate on some loans. We don't charge mortgage insurance premiums. That makes a big difference. We lend more than the value of the house, at least by 10%, maybe more. I'm not going to read off the rest of these. We just talked about them, but in the aggregate, that's a pretty good package of information that encourages people to come visit with us. If we can't deliver a mortgage product that's better and someone else can, that's fine too. The goal is to increase neighborhood home values, not to make mortgages.
Mark, to that point, obviously the high loan to value is an effort, among other things, to increase the value and reduce the gap with the appraisal.
Right.
Is there an exit strategy? When do you think the market, have you noticed the market take off in certain communities and maybe pulled the loan product from those geographies?
Yeah, why don't you save that till the last couple of slides?
Great.
I'll give you graphics about that. and I would say that this strategy and this product was very attractive to the banks because they understood it. In a sense, we were doing the 203K FHA insurance, which insures more than the value of the house with no mortgage insurance premium. And then we were throwing a foundation guarantee, and our foundations have guaranteed the top 10% of the original principal amount for 10 years. Because after 10 years, values ought to have increased. How do we know it's working? Home values go up and appraisals go up, tax base goes up, houses sell, and all the other things on this. We actually track neighborhood activity.
Are you able to track the tax base beyond housing values going up? When, for example, if you go to the city council, do you have actual quantifiable tax base increases?
Yes. Yep. So we do a study every couple of years of home values and activities in each neighborhood. And I wanted to show you a couple of them because they're really instructive to us. The numbers are important, but so is understanding what's going on in neighborhoods. Bel Air Edison in Northeast Baltimore is a working class, mostly African-American neighborhood, originally of lots of homeowners. And what you can see, what's the best chart? If you look at the chart in the upper right, it shows the kinds of sales. And you'll see that the standard sales have now gone up. But during the recession, there were lots of foreclosures. And that really harmed the neighborhood. Today, standard sales are nearly 70% of the market. Boy, that's a good thing. Okay? If you look at the chart underneath it, we actually were able to break out the difference in price, sales price between a standard sale and a foreclosure troubled sale. So in 2019, if a homeowner or a would-be homeowner bought a house, $104,000 on average. If an investor with cash went to the bank and said, I'd like to buy a foreclosure, that number is down at 52,000. This really validates what we're trying to do, which is to get more homeowners involved. And we're trying to twist the arms of banks to hold houses off the market for homeowners. That's hard for them to do. All of their instincts are to sell as fast as they can to anybody with cash. That makes sense. People understand that. We worried that this is a perfect neighborhood to populate with investors and Section 8 voucher holders. If you can buy a house for $52,000 that's foreclosed on by a bank, and you put $20,000 into it, your cash on cash return as an investor is in the mid-teens. That's a pretty good deal for the investor. And so we've worked hard with the neighborhood to try and get more home ownership sales. We're not there yet, but you can see what a homeowner sale does, pushing up appraised values. When the appraiser does the appraisals for us, he doesn't differentiate between an investor sale, troubled sale, or a homeowner. And so investor sales really drive down values and appraisals, which really harms us.
Mark, do you find that many of the residents who use the home improvement loans are also clients who use the purchase rehab, or are they different kinds of borrowers?
They're different kinds of borrowers. Very often they're people who've been in the neighborhood for some time, seniors often, and need to make improvements to stay. And a $10,000 home improvement loan for us, plus a $10,000 matching grant, is a pretty good way to make improvements in a 20-year-old house. And we encourage that. We're finding some people, because we require renovation in our single family loan, some people will buy a house using somebody else's money and then come to us for a home improvement loan. And we're happy to be in second or third position with that.
Mark, you've got two more slides here with different neighborhoods. Is there anything you'd like to point out?
Real quick. So Edna Gardens, you can see what the recession did in Edna Gardens from 2010 on up. This is a neighborhood with no public sector intervention. You can see the number of single family sales has gone up. You can see in the middle right, you can see the values of those houses has gone up. And in many ways, we think we could declare victory and go away. We think our work is fragile, but this is a good example of a place that never should have gotten in trouble.
And Mark, we've got a question here from
Sure.
our viewers. Is a homeowner or borrower expected to own the home for any period of time?
We don't require it, no. And every once in a while, they then move and rent it out. But no, there is a requirement on the city matching grant. It burns off over 5 years. We don't have a requirement. This really is a private loan pool where we have a lot of flexibility to have rules or not. You put just enough rules in, nobody wants to borrow. And borrowing from us is important for us because the banks want us to source loans. Reservoir Hill is different. Big historic houses. There were plenty of vacancies. We made this work because we went and competed for an NSP2 grant 8 years ago. And that let us fill the gap between actual acquisition rehab costs and and appraisals. And you can see that house prices have gone way, way up as the result of the work we've done. And it really is the work we've done. We've invested about $25 million of private and NSP2 capital, made a big difference. And we were able to use the income restricted money to build value, just given what the market was there. That's what we do.
Thank you so much, Mark. One final question before we move to the next speaker is, obviously you, unlike many of our other nonprofits, have a real direct line to the bankers. And are there things that you've heard from conversations over the last few months that concerns them above others? Are they thinking of restricting credit in some ways?
I haven't heard that. We meet every month with representatives of every bank in these loan pools just to keep them informed, and they have a great time second guessing everything we do. But you know, our portfolio is starting to see the results of the COVID virus. We had 3 out of 20 delinquent loans. We had 3 people 2 months ago who said, I'm having trouble because of an issue related to COVID. This month it was over 20. The banks quickly agreed that anybody that called and looked for help, we would give them 60 days without doing any underwriting, which was great. They have not said to us, restrict credit.
Okay.
And you know, I'm not sure that we would, but you know, M&T underwrites for us. They know, you know, they know their own portfolio. We're told that the quality of the portfolio we've built is as good as any affordable portfolio in the country. And that's the result of partnerships with neighborhoods and the city and the neighborhood groups we work with and the banks. But we've not heard credit tightening up yet. We have no illusions. It may well.
That's right. Well, thank you very much, Mark.
Sure.
And thank you for the work you guys are doing out there in Baltimore. It's really wonderful.
Thank you.
Our next panelist is Jeffrey T. Verespi. Jeff is the Executive Director of Old Brooklyn Community Development Corporation. Old Brooklyn is one of Cleveland's largest neighborhoods and is a focal point of the middle neighborhoods work in the city. In 2016, the organization established an innovative community health strategy that blends public health and community development best practices. Prior to his hiring as executive director, Mr. Verespi spent 4 years at Ohio City Incorporated as the Director of Operations and Advocacy. He is a past president of the Case Western Reserve University Alumni Association and former chair of the Leadership Council for the Cleveland Leadership Center. Jeff, thanks for joining us today.
Yeah, thanks. Thanks, Jason. And I want to certainly dive right in so we can get to some of the Q&A. I already saw one that's in there that we might be able to kind of dialogue a little bit with later. Old Brooklyn, for those of you who don't know, is Cleveland's largest neighborhood. It's on the south side of the city. It's about 6 square miles and 35,000 people. And it's kind of what I would consider a quintessential Cleveland middle neighborhood in the sense that it's, you know, Mark used the phrase earlier, fraying around the edges. It's a neighborhood that gradually year over year saw a small percentage decline. And that kind of allowed the Community Development Corporation to say everything is fine. But over 40 years, gradual percentage declines each year are pretty significant. And that led to homes not being renovated and updated. That led to not a healthy churn of new investment, new residents, new businesses. And as Jason mentioned, we pivoted a few years ago with some pretty different approaches to, we think, impact the quality of life for people who live in the neighborhood, but also the community's trajectory through very intentional focuses on marketing as well as Main Street development. And we had some pretty good success. I don't know if you want to keep going to the next slide, Jason. You know, prior to March, I think a lot of our efforts were working. We were seeing a great revitalization along some of our main streets with entrepreneurs, real estate investments, you know, and a fair amount of just general buzz. Well, I think what we're probably most proud of is that because Old Brooklyn is a rapidly changing middle neighborhood, we, demographically speaking, we had a very intentional effort on recruiting and supporting entrepreneurs of color. And I think that was evident in a lot of the entrepreneurs that had opened up shop prior to March 2020. If you look at some of the restaurants and some of the faces behind the shops on our main street. So, you know, we had It's probably close to $10 million of projects that have been recently completed, and kind of moving forward. We hit a quick roadblock. So what were we going to do when immediately, kind of everyone temporarily closed? Thank goodness no one has permanently closed so far, but we knew we needed to do something. The question that came up in the Q&A from Joe Duffy that I want to address is how to communicate with businesses lacking internet presence. It's really hard. It's that digital divide that we all knew about prior to COVID-19 has just been exacerbated. And so although you see one of the things, and I'm going to talk about one of the things we launched, a lot of it's the hand-to-hand conversation, the text messages, the DMs through Instagram, the amount of grant applications that we filled out using Facebook Messenger and Instagram DMs was pretty shocking to me over the last few months, but it was those relationships we had to have first. And yet we know even that communication wasn't enough. One of the things that we immediately launched obviously was those communication efforts. But we also took kind of, what every good organization has is a rainy day fund, and we put it to work. If we've ever had a rainy day in the neighborhood, it's been the last 3 months. And so we took, kind of the pennies that our organization and our board had squirreled away over the years and launched kind of small, kind of rapid response grants for our small businesses. And these weren't big grants. The most amount of money that any individual business could get from us if they got all three funds was around $1,500. So this certainly wasn't going to change their long-term trajectory. But when the first round of PPP was just the unmitigated disaster. Second round was a little slow. Locally here in Cleveland, the mayor's emergency grant fund took 8 weeks to turn around. Our businesses were struggling and they were kind of walking blindly in the dark. And so if we could just even walk into their shop with a $500 or $750 check, that meant a lot to them. We didn't income qualify it. We barely means tested it. We said, hey, did you do something to kind of improve your business as a response to COVID? Update your website, update your Facebook page, sign up for, DoorDash, whatever it is, get some new content for your social media channels. If you did that, we're going to pay you for it. And that has been, really great. That's not money we raised from a foundation. That's not money we went out and asked any, large corporate partners for. Like I said, those were dollars that we just had in the bank. It's about $15,000 we've gotten out the door. I know that's not a huge amount of money, but to the folks on the ground, it matters. And the other kind of response that I want to get to before we go to the next slide related to that is how we help the businesses access the opportunities that were available. We all know the challenges of the government programs federally and I assume locally. I imagine Cleveland's stumbles were the same stumbles that occurred elsewhere, particularly for those businesses with technology gaps. And so we actually launched a program with some partners kind of in the STEM industry to connect high school students who were now going to school at home, who needed to get some sort of kind of hands-on experience. Particularly we focus on high school students who were taking tech or software tech courses. And we connected those high school students with entrepreneurs who didn't have websites, who didn't have Facebook pages, who didn't even have kind of Google landing pages. And so we did all of those, we got about 10 businesses updated tech. We worked with a local partner to get those businesses printers and copiers at home, because if you were trying to fill out those applications and you didn't have a printer or copier or a hotspot at home or internet, you were completely out of luck. And so that was kind of an immediate way to address a student need and an educational need with a small business need. So I can't say that we've been perfectly successful in addressing all of those matters, but I think our businesses have appreciated it. And like I said, at this point, we're not facing any permanent closures. Everyone is going to have to work differently, and that's where the relationships that we've built up over time have led us into kind of how we're going to do things differently.
We've got a broadband question for you about that. Within the CARES Act, there's actually quite a bit of funding to help bridge the digital divide that all of our communities are experiencing. And the Old Brooklyn neighborhood, as I understand it, does have sort of an innovative approach to providing blanket access. But I also know that there's a lot of challenges with those kinds of systems. Could you speak to what Old Brooklyn has and maybe what would be ideal in the future for communities?
Certainly. About nine or 10 years ago, a local council person provided some funding. I actually think came out of the Obama administration to launch a neighborhood-wide wireless program. And so just like if you're on a college campus and you're walking through the quad and you pick up kind of the university guest Wi-Fi network, it's the same thing, but for our community. So we have some built-in benefits for that, but not everyone has a device to connect. And furthermore, Wi-Fi programs have some what we call kind of sightline challenges. If you're going around a building, if you're going through a heavily treed area, if your house is particularly just well built, the point-to-point network of how Wi-Fi systems work are a challenge. And so that's kind of where we do a lot of community engagement on the ground. And we actually have a kind of a technician who will go out and sit in your driveway and sit in your front porch and figure out why you can't connect to this, signal, and whether it's buying you a booster, connecting you to a better device, or whatever it is. So we have some additional advantages, certainly in that situation, but imperfect until you connect to folks' homes. I think there's always going to be that gap. If electricity was only on the pole on the street, I think a lot of us would be pretty cold and in the dark. So that's why you need to be connected to a house.
Thank you. And a follow-up question here we have is with regard to businesses that are adapting, you mentioned, and this sounds great, that you haven't had any officially permanently announced closures, but businesses are obviously adapting. They're doing takeout, they're doing delivery, and many are finding different ways to do business that may be the new norm, not to overuse a phrase. The question we have is, as main streets are the lifeblood of a community, is there any concern that some of these businesses will adapt and not return to the old retail storefront style?
I think absolutely. I think that is a concern. I think that was a concern before this. With first it was we fought the big boxes, and then now we're fighting Amazon. That's where you have to appeal to kind of an entrepreneur's sense of community and their sense of kind of brand connectivity. And so, we actually have one very successful. This is a really acute example of a very successful business who doesn't need a storefront. They lose money on their storefront. And because of this pivot, they've really realized that kind of selling all of their product online just makes sense. And so, why don't they just get a warehouse? And so it's engaging that entrepreneur to understand kind of the brand connection with consumers and kind of the multi-layers of selling your product through experience in the store, through wholesale, obviously, and through online, and all those things are interconnected. But yeah, we have it. It's going to take additional work on public realm engagement and retail assistance. And so I know most cities in the country are leaning into how do we really better use our public realm and create streets for people instead of cars. I think that's probably step one. But I think there's a lot of work on the entrepreneurial side too. So as I mentioned, as when we move forward, it's kind of you have to do everything approach. And back to that question of what's the best way to engage entrepreneurs, but also this counts for residents of as you move forward, you have to throw everything. We've all moved our community meetings online. The experiences that we do still have in person, like our farmers market, have to be safe, and they have to be welcoming. They have to be high quality for consumers to come to make that choice to get out and support entrepreneurs, but also do so in a safe way. It takes doing different things. We've opened up functionally a daily live show on our Facebook channel in which we get on and talk about everything from the music we listened to over the weekend to interviews with entrepreneurs and telling their stories. So, looking forward to taking any questions in the chat later. And thanks for having me on.
Thank you, Jeff. One quick follow-up here from a question we asked Mark. Obviously, all these organizations that we're talking to and all the ones on the call today, face-to-face is the way we're used to doing our work. Virtual community meetings and Facebook Live, you mentioned both of those, specifically with dealing with the current conversation around racial equity and the things that we're trying to push forward as all of our communities face this issue. How can you do that in your virtual communities? Has it been successful, or are there areas you want to further succeed in?
Like with most efforts on race and racial equity, we've had some successes and we've had some failures. The most important thing is acknowledging those and learning from them and getting better. I think it requires intentionality. I think intentionality in stating your objections or your intentions and stating what your value set is, but that intentionality has to move beyond just a statement to actual actions. And so where you are door knocking, because you can still do some door knocking, you can just do some flyering, being very thoughtful about that, and providing alternative options. And I think that's something that isn't going to happen overnight. Building relationships take time, especially virtually. Fortunately, this is something that we started a number of years ago within the neighborhood and at the organization. And so I think, particularly on some of our social channels, we've made a lot of improvement on representation and kind of equal participation within our social channels. And we're very thoughtful in how we measure that. I'll be honest with you, our virtual community meetings are the same folks that came to block clubs, and that's insufficient. But you didn't come to ask me that question fully.
Well, thank you, Jeff. We've got a couple other questions we'll get to toward the end of the Q&A, but thank you very much. Our final presenter is Kevin Nowak. Kevin has been with CHN Housing Partners for over 10 years and was named Executive Director in 2019. Under his leadership, CHN was chosen as the administrator of the first of its kind Lead Safe Home Fund, an effort involving a wide coalition of community leaders designed to support residents and landlords in preventing lead poisoning. As Director of Strategic Initiatives, Kevin led CHN's effort to establish a community development financial institution to address mortgage deserts in low-income and minority communities throughout Northeast Ohio. Prior to CHN, Kevin was at Key Bank as the National Equity Investment Manager of Key Community Development Corporation and practiced law at Thompson Hine, where he focused on real estate law, corporate asset management, and corporate law. Kevin, thanks so much for joining us today.
Hey, Jason. Happy to be here.
Thank you. So tell us a little bit about CHN Housing Partners and your rental portfolios.
Sure, absolutely. Hey, everyone. Glad to be here. For me, middle neighborhoods are personal. I grew up in the city of Detroit in a middle neighborhood, Warrendale on the west side of the city. I've seen where investment and disinvestment within middle neighborhoods can really swing them a couple of different times within my experience in Detroit, and just so pleased to be able to share the information that we have here at CHN. So, CHN, as Jason mentioned, we're a nonprofit. We're based in Cleveland. We have a regional presence now that includes Northeast Ohio, other parts of Ohio. We also serve in Detroit, Pittsburgh, and upstate New York. CHN as an organization, think of us as a mix of affordable housing, developer owner, cap agency, and nonprofit lender. So we do a little of everything from affordable housing to utility assistance, weatherization, counseling, education, community building engagement, and lending within our shop. As a rental portfolio, which I'm going to talk about today, is approximately 2,200 units. We have a rental portfolio that is an interesting mix. As CHN has developed as an organization, when we started in 1981, we were actually created by a consortium of CDCs that as a citywide scaled homeownership initiative. We've since expanded our platform, as I described previously, and each time we've added different housing stability components to what we do, and we've also added different types of asset classes to our affordable housing portfolio. We do everything from single family to multifamily, supportive housing, senior, new construction, preservation. We're best known nationally for our work in the lease purchase world, developing single family homes as a pathway to home ownership for our residents. Our rent ranges, as we see here, are $400, $700 a month. Our area median incomes that we serve in our portfolio are 35 to 80% AMI. I think it's important to note that our families, if you go to a median, are in the 45 to 47% AMI realm. We're kind of at the lower end of workforce housing there. 98% occupancy. So, and our physical occupancy has remained the same and actually improved during the times of COVID. Our typical delinquency being 5% or under, actually it gets a little bit closer to 2%. Once you consider all collections, and that has spiked considerably, which I'll talk about in a second. We have 24 of our properties are what would be considered middle neighborhoods, those primarily being single family homes. Our single family portfolio and our multifamily portfolio are really different, not just as an asset class, but also when we think about the rental income streams. So our multifamily portfolio is almost all subsidized. And within that portfolio, we haven't seen much of an impact of COVID from a rental perspective. Of course, we've had to make adjustments to make the environments safer within the COVID environment. But in terms of our ability to capture rental revenue, there hasn't been much of a difference, because as you know, if you're subsidized, let's say it's Section 8 contracts or others, what you're able to do then is to requalify the tenant to increase the amount of the subsidy. However, in our single family portfolio, our single family portfolio is primarily unsubsidized. And within that portfolio, we've seen a considerable increase in our non-payments. We think that our residents are a good representation, not just within the low income segment, but also within the broader workforce segment, being on the bottom end of that. And what we found within our portfolio, even though I showed a median there of 45 to 47%, what we are finding in the people who are non-paying is that they're trending toward that 50 to 60% space, as opposed to the 30 and 40% space in terms of their income levels. What we've done within the time of the COVID crisis is to really take a data-based approach and reach out to our residents and try to understand from them why why they are not paying. And we've been watching our trends. We check in, on our payments really on a weekly basis. But what we've seen, if we start looking in April, we saw a considerable spike within our vacancies. What I should say is our non-payments, and thereby our economic vacancies. So we went from a scenario that I mentioned earlier that was kind of under 5%. To, as of April 10th, a non-payment rate of about 26%. So just let that kind of soak in for a second, because that's a really significant increase. So that's 200 within our portfolio. That ends up equaling about 200 plus total delinquents as of April 10th. So that sort of spike will hurt any portfolio. And what we saw through the month of April is a downward trend from that initial spike to a non-payment rate by the end of April at a little under 10%. So and so for us, that equals an almost 2 times increase in non-payment, over that period. But we did see a decrease in non-payment over time. And from that initial time in April to the end of April, we reached out to our residents. And in April, what we found was a number of the residents didn't think they had to pay. Some of them had been impacted by COVID. Some of them saw this as an opportunity, because there are not evictions taking place, to conserve their cash, because they did not have a fear of being evicted, but they're conserving their cash because they were afraid of the economic crisis. And then we had others who, had seen in the media, hey, there's eviction moratorium. I guess I don't have to pay. That must mean a rent holiday. So we saw a catch up, by the end of April. In the month of May, we saw less non-payments right at the beginning of the month. A lot of those folks that had been otherwise educated, in April, paid on time in May. But then by the end of May, we had seen a continued increase in total non-payment, getting up to 13.25% by the end of May. So seeing an uptick. During that time, we saw also an uptick in people who were responding as to the fact that they had lost their jobs or had reduced hours, for some reason for COVID. Finally, as we get into June, we saw an even greater increase at the beginning of June. We saw an increase that went up to 33%, economic vacancy, 30% total not paying at the beginning of June. And we attribute that to a combination both of people who have identified themselves as having been impacted by COVID, again, either being sick, lost a job, reduction in job, having to take time off because they have to care for a loved one, a child, or someone else who was sick. And we're seeing a downward trend through the month of June again, though it's still higher than it was at this point in May. So we will know, after today what that number looks like at the end of June, but we're thinking it's going to creep up to closer to 15%.
Hey, Kevin, a quick question. You mentioned that there was a shift in those that were non-paying to a higher AMI group. Was that correlated with job losses? What were you hearing as the reasons?
Yeah, that's what we were hearing over time. On average, we were seeing job loss. And seeing a difference in the trending between, from the beginning in April through June, and with a correlation through June of a higher amount of job loss. Is that straight across? And so, kind of the next step to that question, Jason, is: was there a difference between folks who are in the, let's say, 30 to 40% range versus 50 to 60% range in terms of job loss? We didn't necessarily see that much of a greater increase there between 30 and 40 and 50 and 60.
You also mentioned that you do a very proactive role, almost weekly, of phone calls. Were there non-payments that were still unexpected? People saying, no, I anticipate being able to, and either being unable to say for sure what their financial situation would be, or perhaps having in the last week a hardship, or were your projections in line each month so far?
At the beginning of the crisis, we took an approach of doing an extreme sensitivity analysis, and it looked at our break even in our portfolio at around 15%. From there, we were very surprised in April and in June by the spikes. We were taken off guard more so in June than in April because it had spiked up so significantly at the beginning of June. And what else we've done, when we've been reaching out to our residents is to refer them to our counseling arm. We have at the beginning of this crisis, we had some limited rental assistance that we had already available. Throughout the crisis, a couple of our partner organizations, such as Eden Inc. and it's based in Cleveland, had some additional assistance. And now, CHN has been awarded contracts from both the city of Cleveland and Cuyahoga County to run a countywide rental assistance program that will help residents throughout Cleveland, Cuyahoga County up to 120% area mean income to pay their rent in the event that they had a COVID-related issue paying it.
And how is that defined? Is there a single definition, or is it open to interpretation?
In terms of COVID crisis, COVID, yeah. So what we'll be looking for are people who are able to evidence a loss of job or hours. There's a number of ways that you can prove that up. One way that you can prove it up is through your employer letter. Unemployment letters. The unemployment letter is, we want to make sure that we're thoughtful and cognizant around those who have had an expanded availability of unemployment. One of the concerns that I think we've all seen in this crisis is that, small business owners were uniquely impacted in a different way than they have been in the past, with having to shut down, large parts of our country. So we want to make sure that we're reaching, people that we may more traditionally serve, and those that, are entering into this crisis mode maybe for the first time in their life.
And Kevin, you mentioned earlier that your organization also helps with emergency supports with utility payments and things like that. Working with your partners in the region and in Cleveland, what are the supports still going to be ongoing throughout the summer? What is your role in terms of advocating the need of your residents?
Yeah, sure. So, we really serve as a one-stop shop, as you mentioned, Jason. So we can cover everything from rental assistance to emergency utility assistance. We can also cover, people who otherwise, let's say their hot water tank went out, and if they income qualify, we can do those sort of emergency improvements for them, whether they aren't a CHN resident. We serve approximately, up to 40,000 households a year, unduplicated in our efforts. So we're able to provide that full set of services, and for those residents who otherwise are not COVID related, which there are some, unfortunately, we have other rental assistance that may be available to them that's non-COVID related, as well as a full counseling and education arm that can help with eviction prevention and other stresses to their housing, such as foreclosure.
Now, a consistent theme on this webinar, and I think across the country, is communication channels and how we reach our audiences. With regard to the countywide CARES Act support, obviously it'll be beyond just the phone lists that you have for all of your residents. How can the county, how can other cities around the country do their best to be able to communicate to residents who are typically going to be at a disadvantage in terms of communication opportunities, to know that there's assistance out there? What are you guys planning?
Yeah, sure. I think it's a great question, Jason, and that's something that we have been really cognizant and focused on since the beginning of all this, because there will be residents within Cleveland Cuyahoga County who are looking for assistance for the first time. So there will be an 800 number. There will be a website. Those will be going live tomorrow. So I can't share them just yet. They will be going live tomorrow. We will be communicating through a number of channels that are traditional, non-traditional for us. So, you think through non-traditional would be, the Northeast Ohio Apartments Association, right? That's going to cover a much broader population than does cover our typical. You think about the Akron, Cleveland area, Realtors Association, the Realtors Association, both of those that work with property management companies. You think about Ohio Means Jobs, Child Family Services at the county level. So we're going to be looking at ways to reach that kind of non-traditional working group as well.
And thanks for that, Kevin. Lastly, a question just generally, obviously with the CARES Act funding, your organization and those that are going to be experiencing some losses in revenue should be able to make up for that a little. But we've noticed with PPP, with a lot of other of the federal programs, that eventually the spigot does disappear. What's the long-term plan? How do organizations like yours, how should they plan over the next 6 months, let's say, if the hardships continue for our residents to be able to stay afloat and not have to look into either eviction or alternative methods?
Yeah, so I think a concentrated effort on rental assistance is step one. And so we'll be reaching out to some of the groups I mentioned earlier, as well as other partners of ours that we work with frequently. The city of Cleveland and Cuyahoga County have both identified a plethora of different organizations, again, traditional, non-traditional, to help with that. That's one step. PPP was incredibly important and useful for us. We're 180 person staff. By the end of this year, we will be 200 plus with the various different work that we're doing. Jason, you mentioned earlier the lead work. The temporary hiring that we'll be doing for this rental assistance. We actually got an increase from the state of Ohio that will increase our staffing by 12 additional staff members on got regular hires for the HEAP, expanding our capacity there by about a third. So, I would say managing your cash, is something that's been important for us. We've cut back on, a lot of our expenditures. There's been some natural savings for us, because we are not doing the travel that we would, or spending other, I think we've cut back on some of our, elective hires that we would be doing. Something like we've been looking at our office space. We were going to be holding off on that investment, to 2021 now. So there's a measure of, being cognizant and accessing those public resources, as well as, thinking critically about your spending during this time.
Great. Thank you, Kevin. And thank you to the panel. I've got a question here. It's sort of to the whole panel, but some of you may have some more specific responses. It says, what is being done in Cleveland, but I'll open up to Baltimore as well, Mark, if you have some thoughts, to assist small landlords. So those with a portfolio of fewer than maybe 10 or so units, who are obviously on tighter budgets and are really being pulled by both sides of the issue.
All right. I learned a lot more about rental assistance today than I did from the mayor here yesterday. I think we're at the very beginning of that here.
Hmm.
Yeah. This is Kevin. I think, for small landlords, and if you are in, Cleveland, kind of Cleveland area, feel free to reach out. I think there's a couple of things. One, we are making this kind of information widely accessible. I think that landlords are really important in this. If you look back at Rahm Emanuel's quote about never waste a crisis, that phrase became politicized. But then the next step, of that quote actually said something to the effect of, because it's a time for you to accomplish what you never thought possible. So, we're at this kind of apex here in Cleveland, Cuyahoga County, of landlord engagement in a much different way. And so, CHN is also a landlord. We don't just work with, we understand what it means to be a landlord. And we think that there is a real opportunity here for landlords, to access rental assistance, to access the Lead Safe Cleveland, Coalition's home fund that we're administering, and to work together in a way that has two important, kind of mission critical pieces. One being, housing stability for the tenants within your, 10 unit or less portfolio. But then number two, to allow for you to, as alluded in the question, to maintain stability for yourself financially within that portfolio. Because if you're stressed as an owner, that's going to add additional stress to the units, which will add additional stress to the tenants. So there's a twofer there, that we understand, and that, we are hoping to be able to coordinate differently, with landlords. Oftentimes it's been the tenant that's in crisis that reaches out. But I think that we can change this dynamic in a way where a group like CHN, who has this large scale resources, can work closely in a coordinated way with landlords, such as yourself, that have 10 units or less.
Thanks, Kevin. We have a few minutes left, and so if there are any other questions, feel free to throw them into the question and answer box, and we'll get them to our panel. Jeff, this is a good opportunity for a question for you. You mentioned that Old Brooklyn CDC has really aligned its work to something called a community health perspective, and obviously right now health is the watchword of all of our work. Can you explain how a community health organized CDC approaches the COVID-19 crisis?
Yeah, like so many other things, the crisis has just made more clear who we are and what our priorities were, Jason. So I think it has actually just sharpened that tool. The reality is the community development corporations have been in the social determinant of health business for 50 years. We just maybe didn't know it, and we certainly didn't measure it that way. And so, our work is very focused on measuring outcomes related to kind of the conditions that impact someone's ability to live a successful life. Their access to healthy, safe housing, their feeling of community cohesion and community empowerment, their ability to access food, digital access, economic opportunity. Those are the tools that we measure, because we know that those impact, not just how long someone's lived, but the quality of life that they live. So this is actually, I actually think, made our work around healthy housing economic opportunity, food access, even more critical. I think a challenge is that in a crisis, we immediately have to respond to basic needs, which is obviously necessary. But once those needs are met, we need to make sure we pick the ball back up to address kind of those structural issues that might be holding folks back. So there's that work has not slowed down. It maybe just was put on pause while all of our partners were responding to critical care needs.
Thanks so much to Jeff. And with that, we're going to go ahead and wrap up our webinar today. Thank you all for attending. Thank you to Mark, Jeff, and Kevin for really telling us about 3 very important components of our work, and I think sharing a lot of really interesting information. If you like more information about our work, of course, middleneighborhoods.org. And generally, if you have any questions or would like to get in touch with all of us, you can reach out to us through our emails in the listserv. Again, thank you all, and be safe and healthy, and have a great rest of your week.
Thank you.